Welcome to Module 5 of Tackle Trading's 7-Step Guide to Trade. This is Coach Matt. Pleasure to be with you for yet another session in the 7-Step. And we are going to be talking about placing the trade, and we'll get into that here in one moment. But as we always do, let's just quickly recap through the initial steps. The first thing we want to do is start at the top of the market to determine a bias to the market so that we're always trading in the direction of the overall market. Step 2 is we want to choose the appropriate trading strategy to match that bias. Step 3, we want to find and analyze potential trades. Step 4, we want to go out there and plan the trade by getting our entries, our stops, and our targets. And then step 5 is once we have prepped the trade, we want to go out and place the trade. And what I want to focus on here in step 5 is just that, is placing the trades, and specifically the orders that you want to start understanding to place both stock trades and specifically option trades as well. Now, when it comes to orders, there are some basic types of orders that you have to understand, and we'll get into some of the little bit more advanced orders here in 1 second. When you're buying a stock, you simply have to buy it to open the trade. It's called BTO, buy to open. Once you buy something, you now own 100 shares, 200 shares, 500 shares. To close that transaction and lock in those profits, or to lock in the risk, you have to sell to close the position. So if you buy 100 shares, you sell 100 shares, you have 0 shares. Everybody understands that. And the reason I bring it up is because when it comes to shorting stock, not everybody understands that process, but it really is the exact same as buying a stock. You just flip them around. So when you're shorting a stock, you don't own anything, you sell to open the transaction. So I sell 100 shares, 200 shares, 500 shares, and in my portfolio it will read as negative 100 shares, or how many ever shares you are trading. To close that transaction, you simply have to buy it back or buy to close. So if I short 100 shares minus 100 shares and I buy 100 shares to close the shares, how many shares do we have? We have 0. It simply closes the transaction. So you're not really buying anything, you're simply buying to close the transaction. Now, the basic order types, there are 3 basic types of orders. The first one is what we call a market order, and outside of trading during the day trading, we don't deal with a lot of market orders, especially if you're leaving an order open overnight. You don't know exactly what the next day's price is going to be. So I would like to shy away from the utilization of market orders unless you're doing something active on a stock that is trading during the day. Market orders are used to buy or sell a stock immediately. So you're buying, whatever the price is, I want to pay that price. Whatever the price is, I want to receive that price. So if the market's trading for $90.58 and I put a market order in, depending on the slippage, it's going to be somewhere around $90.58 if the market is open. But if I place a market order when the market is closed, it's going to go into the market at the next day, and I want to shy away from that because, again, we don't have any control in. So we just simply don't want to use those orders because we don't know exactly what the price is going to pay. The second type of order is what we call a limit order. A limit order is an order to buy a security at no more than a specific price. So for example, if I wanted to go in and buy a car, and I went into the used car dealership or the new car dealership, whatever dealership you wanted to buy a car from, and the sticker price was $30,000. And I offer to the salesperson $25,000. My limit, the max I'm willing to pay, is X amount of dollars. And the market, in this situation, the sales individual would have to come down to my price before I would actually buy that product. The same thing goes in the stock market. If XYZ company is trading at $30, but I see a really good opportunity to buy it at 25, nobody's going to sell it to me at 25. If I put a limit order in, it has to go to 25 before I actually buy it. So a buy limit order is anything at or below. Now, if the market can sell it to me at $20 and I was willing to pay 25, they're going to deliver it to me at $20. So it's anywhere underneath that. So a buy limit order is anywhere underneath that whatever specific price you put into the market. Now, the third type of order is what is called a stop order. A stop order is not technically an order. That's the market and the limit order. A stop order is what is known as a trigger order. It triggers a market order if there is no limit attached, but if there is a limit attached to the stop order, then it triggers a limit price. So a stop order used by itself, such as a stop loss, a sell stop, that will trigger at whatever price you put it in or below that price. A buy stop is at or above, a sell stop is at or below. Most stop orders are used for stop losses, both on buying stock and shorting stock. They're also used in conjunction with a limit order when you want to control your entry into the position. So the only way a stop order is used as a limit is combined in that order type. Otherwise, stop orders will trigger market orders, which will basically trigger at whatever the next available price is. And then your last one is what we call a contingent order. And a contingent order is widely used in trading options because as an option trader, we don't specifically know what the price is going to be at, say, an entry or a stop loss or a target. So what a trader can do is they can determine to use a contingent order on the stock price that will automatically close their option trade at whatever that price is. So a contingent order, once again, is not technically an order. It triggers in at a specific market price based on the stock. Now, you can also combine the stop and the limit order to create sell stop limits, buy stop limits to control your entry into the position, and that is typically the way traders will want to control their entry into that position. Now, in terms of the overall mechanics of placing orders, let's go back to just a simple example. If you'll recall from session 4, when we were looking at these technical patterns and prepping the trade and determining where to buy a stock versus where to put a stop loss and where to target, in terms of those orders, the first order to buy is what we call a buy stop limit. That order allows us to control our entry into the position. Once again, it's called a buy stop limit. The second order is what we call a stop loss order right underneath support. So in case the stock reverses and goes against us, it will automatically close us out of the position if the stock does in fact break that support level. And then the third type of order is what we call a sell limit order. So if the stock, once I have these orders, I placed them into the market, once we do get that confirmation and we get into the stock trade, our orders, meaning our stop loss and our target order, specifically the sell stop and the sell limit, they automatically go to the market in what is known as an OCO order, or one cancels the other order, and it's whichever one gets hit first. If the stock goes up to our target, we're going to sell the stock at our target, lock in our profit, and that automatically cancels the stop loss order. If the market comes down in price, hits our stop loss, that will automatically sell the stock at a loss. It was right there under support. It worked the way we wanted it to happen, and it automatically cancels the sell limit order they have. So when you're doing a type of trading called swing trading and you're looking at pivot to pivot and you want to buy it at support and sell it at resistance, the process to put the trade on is called an OCO bracket order. The order to entry is referred to as a buy stop limit. We'll get into a case study here in 1 second. The order to close the transaction, if we're wrong on it, is called a sell stop. That is otherwise known as a stop loss order. And then the target order is what we call a sell limit order. On the flip side, looking at shorting stock, the orders are going to be very similar, but like many things in shorting, there are some subtle changes. The entry order is obviously not a buy stop limit. This time it is a sell stop limit, controlling our entry into the downside. Total order is called an OCO bracket order. That allows us to also place our stop loss, which is now a buy stop order, and it also allows us to place our target order, which is called a buy limit. So as you can see, in shorting, it's the same process, it's just flipped upside down. So to entry, it's called a sell stop limit that controls our entry into the position. The stop loss is referred to as a buy stop. That is typically placed right above your resistance channel. and your target order is called a buy limit. The combination of all three of these orders is what is referred to as a OCO bracket order. So let's go into the market and let's show how to put the order on. Now, as you can see, we're here at the Tackle Trading website. We're going to go to the reports. We're going to go down to the options report. We're going to click on the first report, which is the latest report, dated options report, January 12, 2019. We're going to scroll down to the options report. There's the bull watch list. There's the bear watch list. And let's look at a couple of these stocks. Here's Salesforce. Really like the breakout on Salesforce. That's a potential trigger already. CTRP. Look at that potential breakout on CTRP. Nice little breakout. First Solar, wanting to break out on top. Herbalife, little retracement, upward movement in price, like that trigger as well. Lilly, little break of 120, not there yet. Merck forming a little bit of a bullish retracement, upward movement in price. This candlestick pattern is what is called a bullish engulfing candlestick pattern. High probability candlestick pattern to drive the market back up. Twilio here, good little breakout on Twilio. And then we have also WWE, breakout continuation. So we found CRM, we found Twilio, we found WWE. All of those are pretty good. So let's go into our broker software. So we got WWE, nice breakout there, continuation. I like that trade. So we're going to prep here WWE. Now, it is currently, right now the market is closed. And as the market is closed, you see no price action going up or down. Now, the stock market is closed today. It won't open until tomorrow at 9:30 a.m. Eastern Standard Time. Between now and that moment, even though the stock market is closed, you still have orders coming in that's going to be priced in at the beginning of the opening tomorrow. And so we don't want to place a market order because we don't know exactly what that price is going to be. You might have news come out on WWE. Maybe it's good news, maybe it's bad news, but you might have some news and WWE could gap up all the way up to here, could gap down all the way down to there. So what we want to do is to control our entry into the position. We're going to use an entry order called a buy stop limit. I'm going to place that order right above the high of the day. So right above the high of today's candle, I'm going to place an order to get into the position. So if tomorrow it starts going up in price, we then get into the position. Now I want you to think about something very quickly. If tomorrow it goes sideways, we don't get into it. If tomorrow WWE comes down in price, we don't get into it. The only way we get into this transaction, if tomorrow we have an orderly increase in price that goes above today's high and triggers us in. We want to get in when we see momentum coming into it. So we don't want to buy if it goes down tomorrow. We don't want to buy if it goes sideways tomorrow. We only want to buy as it goes up in price tomorrow. Now, coming back to the Tackle website, let's go ahead and get our orders here. So our entry order was anything above 80. You can see it already triggered here. So we're going to trigger above today's high. Our stop loss was below 77. And our targets were 86 by 97.5. So what I'm going to do is I'm going to right click, go down to buy custom, and you see where it says OCO bracket order? That's the order that's going to allow you to pull up all orders in the same transaction. Now, your first order is your entry order. It simply says limit. We know we need to change that to a buy stop limit so that we can control our entry above the high. Our limit order, this is our target order. We are willing to accept X amount of money. That is our target order. And I'm going to place that target order, our second target, 97.5. The third order down here is your stop order. and we're just going to change that. It was under 77. We're just going to put it at 76.50. Just get it right underneath that support level. Now, the next thing I need to do is to change my entry order to make sure it goes above today's high. Now, when you're looking at these candles here, you have your open, your high, your low, and your close up at the top left-hand side of the Thinkorswim monitor here. So I'm going to highlight that candle, and you can see the high of the day, as categorized by the H, is 82.59. Now, a good rule of thumb is to use what is known as an ATR to determine how far above the high you want to use that order. So I'm going to go back to my analytics software, and you can see this stock right here has an ATR of $3.38. That means that on an average day from the very high to the very low of the stock, it moves $3.38. What I'm going to do is I'm going to place an entry order that is 10% of the ATR above the high, and then I'm going to bracket the order in by adding another 10% of the ATR to create the limit order. And what you'll see is how we control the entry into the position. So if the high of the day is 82.59 and the ATR is $3.30, we'll just call it $3.40. We'll round it to the nearest number. 10% of that is 34 cents. So I now know where I need to place that buy stop order is I take 82.59, I add the 10% of the ATR, which equated to 34 cents, and that's going to put that buy stop order at 82.93. So let's change our buy stop order right there to 82.93. I have a buy order to go above 82.93. So if tomorrow the market goes up to 82.93 or anywhere above that level, I'm going to get into the trade. That controls and protects against the market going down tomorrow. So if the market goes down tomorrow, I don't care because I'm not in the trade. I only get into the trade if we go up. But what if the market gaps up in price? What if the market, WWE has some good news overnight and the market gaps up to $94? Do I really want to pay $94 when my overall top end of resistance was 97? That was my target. So no, I don't want to do that, which means I have to control the upward gap as well. That is why we do a buy stop limit. So now we're going to add the limit price, which is the max price I'm willing to pay. And we're simply going to add another 10% of the ATR to that price, so 82.93 plus the 34 cents, which is 10% of the ATR. We're going to bracket that in at 83.27. So now I come down to the overall limit here, and I type in 83.27. The last thing I need to do before I place the actual order is I need to change what is known time in force, TIF. You have a couple different time frames, day order and a GTC. Those are the two core time frames of orders. Day orders mean they are going to be canceled at the end of the next trading day. So because the market is closed right now, they will be canceled at the end of tomorrow's trading day. If I put that order in today, they'd be canceled at the end of today's trading day. So whatever the next trading day is, that's when this order is going to be canceled. Now, because I may want to adjust my entry if we do not get triggered in tomorrow, I keep the entry order as a day order only. The red orders, these are your selling orders. That is your target order. That is your stop loss order. If we do get triggered into the trade, I don't want my target order or my stop loss order leaving the market. I want them to work for me in the market, so I need to change those to what is called a good till cancel trade time frame. And so my entry is a day order only. My stop loss and my target are good till canceled. We got a good trade. You got your 100 shares. Confirm. This will walk you through the entire order process to make sure you're doing it accurately and send into the market. Now, as you can see, we have an entry order. If we go up in price tomorrow, we're going to get triggered into the trade. If we get triggered into the trade, our red orders, our target order and our stop loss order are also triggered into the market at that point. What I would recommend, especially if you are new to the market, is practice what I just showed you 10 to 15 different times over the next couple weeks. And as you get a little bit more experience, everything else makes a lot more sense as well. Repetition is key. And if you need to go through it again, go through it again. Rewind the video. You have access to it. But make sure you get out there and you practice. If you've been enjoying what you've seen so far in the 7-Step Guide to Trading and you want to take it to a new level and you want to become a part of our community and get access to all the scouting reports and everything else, you can sign up for a pro plan of tackle trading. You get 15 free days on us, and we all know what's in the box, so let me quickly go through it. All rookie and varsity content, all of our blogs, all of our scouting reports, stock, options, commodity, Forex reports. You get access to the Daily Traders Lounge, the coaches shows where we detail a lot of those directional swing trades, Cash Flow Club where we go through our cash flow strategies, Mind of a Trader webinar series where we get into the mindset of the different coaches and traders over there at Tackle Trading. And for those of you who are very new to the market, you also have the Tackle 100 series, Technical Analysis 101, Options 101, Futures 101, also System Development 101. And it's very easy to get that 15 free days on us because all you got to do is go to bit.ly/join tackle pro and you get 15 free days to test out all of those amazing products and becoming a part of this absolutely amazing community. So once again, it's bit.ly/join tackle pro. And as we end this session, as we like to do, I'd like to give you a little bit of a testimony by somebody in our community. Audie, thank you so much for putting this out there on Trustpilot, a wonderful community that not only teaches principles of trading and investing, but also a way of life. Thank you, Audie, so much. We believe in those principles of trading and investing, but you also have to work on that proper mindset. That's why that mindset of a trader webinar series that we do 2 or 3 times a month over there at Tackle is so important. So, Audie, again, thank you so much for that. In the next module, what you're going to be focusing on is managing of the trades. So we found the trade, we placed the trade, now we got to go through the management process of the trade. This is Coach Matt for Tackle Trading. Hope you enjoyed the module.